Welcome to the Big Beautiful Bill, the good, the bad, and the taxing. I'm Philip Corson, a certified financial planner professional and estate attorney for more than 20 years.
And I'm Mike Flanders, a CFP with a couple extra decades of experience helping retirees and pre-retirees make smart tax decisions.
And in this series, we're going to help you learn the rules, dodge the pitfalls, and find your opportunities under the new law. All in short, easy to follow sessions.
So here we go. This is part 1 of 4. Today we are going to cover the big beautiful bill, what retirees and pre-retirees need to know. So you'll walk away knowing exactly how the big beautiful bill, or OBBBA, could affect your retirement plan.
So today's goal is simple. We want to give you a clear picture of what's actually in the big beautiful bill so you can see what might help, what might hurt, and what you should be thinking about next.
So at a glance, here's what's in the law. Permanent lower tax brackets, bigger standard deductions, a temporary extra deduction for seniors, state and local tax cap relief for some, a very high estate tax exemption, and a couple of small targeted deductions.
It sounds simple enough, but each of these has details and timelines, and that's where planning really becomes important. These changes aren't just numbers on a page. They affect how much you keep, how your Social Security is taxed, and even how you should plan withdrawals from retirement accounts.
Yep, and on the legal side, since I'm playing an attorney on TV sometimes, they can change how you structure your estate plan, protect assets, and avoid costly mistakes later.
Absolutely.
So the lower brackets from the 2017 law, which was called TCJA, or Tax Cuts and Jobs Act, that 2017 law now is permanent. Again, that means until Congress decides otherwise.
Right. So for 2025 to 2028, if you're 65 or older, you can take an extra $6,000 per person deduction on top of the standard deduction.
Ooh, yes. So for a married couple, that's $12,000. But you do need to realize that it does start to phase out at $150,000 of income.
Mm-hmm. The state and local tax deduction cap goes from $10,000 to $40,000.
And that is a big deal in high tax states like New York or California. Here in North Carolina, South Carolina, where we are, the benefit's more modest unless you have high property taxes.
And remember, this too is temporary. The cap drops back down in 2030 unless extended.
So the estate tax exemption, let's talk about it. It's now $15 million per person. So most people will not owe federal estate tax.
Right, but estate planning is still critical. Avoiding probate, ensuring your wishes are followed, protecting assets from nursing homes, those things remain just as important.
Yeah.
New deductions include up to $10,000 for car loan interest with conditions, and a small above-the-line charitable deduction for non-itemizers.
And remember that some changes started back in January. Others start later this year, and most expire within the decade.
Yeah.
So with lower income tax rates locked in for now, Roth conversions may make some sense, especially in lower income years.
And managing your income can help you keep the senior deduction and avoid unnecessary taxes on your Social Security.
Yes, and asset AVT, alignment, verification, tracking, plus extended care planning keeps your financial house in order.
The biggest mistake, I think, is assuming that a headline applies to you without checking the details.
Yeah, or ignoring the headlines. Once the tax year is over, some opportunities, they're just gone for good.
Yeah, planning early means more options. It gives you more time to squeeze things in before deadlines, and then you end up with fewer surprises.
Exactly. So now that we've covered the key provisions of the Big Beautiful Bill, let's open the mailbag, tackle some real life questions from some folks.
All right. Let's see. First up is this question from John and Susan in Rock Hill. My spouse and I are both over 65 and living on retirement income. I heard there's a new $6,000 deduction for seniors. Will that lower our tax bill, and do we have to do anything special to get it?
Okay. So if you're 65 or older, your income is under $150,000, the bill gives you an extra $6,000 deduction each. So that's $12,000 total. Whether it will reduce your tax bill depends on your income. So keep in mind that the deduction begins to phase out for joint incomes. That's your total income there. That is above $150,000, and then this whole thing expires after 2028. So there's no special form required. You just have to file a return and include your Social Security numbers in it.
So this is a big one, I think, for our clients. Since both spouses are over 65, they not only get the new higher standard deduction of $31,500,
Right.
they also get the current age 65 plus amount, which is $3,200.
Yes, yeah.
And on top of that, they get the new temporary senior deduction of $12,000.
Right. So assuming your income's under $150,000, you'll get a total standard deduction of $46,700. In fact, the other day I was running a pro forma tax return for 2025 for someone to decide on some withholding from IRA withdrawals. And I saw this number. They've already built this into the tax programs now. It's interesting. So
it's great.
I was like, where is this number coming from? Well, it's the addition of all these factors that we just talked about.
And you don't have to do anything special to get it, fill out any special forms.
I mean, it just automatically calculated it when I put it in the system.
Nice.
Okay, so our next question is from Mark and Emma in Charlotte. We've always taken the standard deduction, they say. Will this new law make sure we can keep the larger deduction we've had the past few years?
Yeah. The larger standard deduction from recent years is now locked in permanently.
Permanently again.
Right. So that's $15,750 for single filers. Yeah. And it's $31,500 for married filing jointly. That means more retirees can keep things simple without having to worry about losing their tax benefits.
Yeah, it's one less thing to worry about for the time being, which makes planning a little easier. And I know when we're preparing tax returns for folks, a lot of times they'll say, do we need to gather all our medical expenses and all? Most people don't need to anymore. I mean, it's a huge percentage that do not itemize and don't need to worry about it. And it's not a negative. You're still getting that bigger deduction that's even more than what you actually spent. So it's a good deal.
Right. Yeah. I think may want to keep track if there's charitable giving and things still.
Yep, because of that charitable extra amounts you can do
for non-itemizers.
For non-itemizers.
More on that later.
Yeah, that's right.
Here's another question. This one's from Tom and Nancy. We're in North Carolina and we don't pay a huge amount of property tax. This SALT cap increase, will that help us at all?
Well, probably not, okay? The higher $40,000 cap will mainly benefit people in high property tax states like New York and California. But if you own a beach house in a high tax area, it could be useful for a few years before it drops back to $10,000.
It's good to know the rule, but not a big factor here unless your taxes are unusually high.
So lastly, here's one from Connie and Richard in Charleston. We've saved a good bit over the years. Does this extension mean we can pass more to the kids without estate taxes?
Yes. The higher estate and gift tax exemptions have been extended, giving you more room to transfer wealth tax-free during life or at death. For most people, it means federal estate tax won't be an issue at all.
Right. So that's great. So now the kids can fight over your vacation home instead of your tax bill.
Yeah, right. Which is just another reason why estate planning is still important.
It sure is, yes. So if you've learned anything today, it's that the Big Beautiful Bill has many layers, and your plan should be built with those in mind.
And that's why we want to invite people to our Investing 101 program on September 13th. We're going to be having a breakfast session in Clover, South Carolina, or a dinner session in Jamestown, North Carolina, your choice.
Yeah, or you can come to both. RSVP at spcinvesting.com or planningyourlegacy.com.
We'll see you there. Help you figure out how to apply this to your own retirement plan.
So thanks, everyone. Really appreciate it, and we'll see you next time.
Take care.